Welcome, traders and financial enthusiasts, to a deep dive into the shadowy world of market manipulation. Today, we're pulling back the curtain on how powerful players can influence asset prices, often at the expense of the unsuspecting public. We'll explore historical and modern examples, from the infamous Rand manipulation case to George Soros's legendary raid on the British pound, and even a tale from the Napoleonic Wars. Crucially, we'll connect these events to a powerful framework used by institutional traders: accumulation, manipulation, and distribution, or AMD. Understanding AMD isn't just about history, it's about recognizing the patterns that shape our markets today.
The Constitutional Court heard arguments around how the Competition Appeal Court erred in the judgment it handed down in January last year, in which it upheld the appeal by the majority of the respondent banks accused of currency price fixing. Representing the Competition Commission, Advocate Tembeka Nqaitobi argues that the Competition Appeal Court dismissed and failed to analyze the economic evidence of the case.
And one of the most glaring failures of the CAC is the absence of any meaningful analysis of the impact of the trading data. But in cartel cases, economic evidence or trading evidence is as valuable as communication evidence. They focused only on the express communication in the chat room and did not pay attention to the unexpressed conduct.
In arguing jurisdiction, Nqaitobi told the Apex Court that the Competition Act enables the Commission to exercise its jurisdiction regarding economic activity across borders.
On territorial scope, it addresses itself to the physical borders of South Africa within the Republic. But it also addresses itself to conduct outside of South Africa, provided that it has an effect in the Republic or within the Republic. I think that's the actual word, is within the Republic. So what this means is that it's crucial that the analytical approach that the court takes is A, work out who are the members of the SOC without considering the issue of jurisdiction. And once you know who the members of the SOC are, then work out who do we as South African courts have jurisdiction over, who is within the SOC, and then exclude those that you have no jurisdiction over.
Nqaitobi SC detailed the strategies used to fix the currency by the traders in chat rooms, which include the exchange of information and currency manipulation, saying that South African consumers will have been affected by the alleged manipulation of the Rand. The case continues.
Let's begin with a recent and highly impactful case: the manipulation of the South African Rand. For years, allegations swirled that major international and local banks colluded to fix the price of the USD/ZAR currency pair. The South African Competition Commission launched an extensive investigation, uncovering a sophisticated scheme that allegedly ran from 2007 to 2013. The impact on the South African economy was significant. Artificial fluctuations in the Rand's value directly affected the cost of imports, leading to higher prices for consumers and contributing to inflation. It eroded trust in the financial system and highlighted how easily a few powerful entities could distort a nation's economic stability for their own gain. While some banks, like Standard Chartered and Citibank, have settled with the Competition Commission, admitting liability and paying fines, others continue to contest the allegations in court. The case is a stark reminder that market manipulation is not a relic of the past, but a very real and ongoing threat. At the heart of this scandal were private chat rooms, often on platforms like Bloomberg, where traders from competing banks exchanged sensitive information and coordinated their actions. These weren't casual conversations, they were strategic discussions aimed at influencing the market. the methods were varied and insidious. Traders were accused of fixing bids, offers, and bid-offer spreads, effectively controlling the price at which the rand was bought and sold. They also engaged in tactics like, to truly understand these events, we need a framework. This is where the inner circle trader, or ICT, and his accumulation manipulation distribution, AMD, model come into play. AMD isn't just a theory, it's a practical lens through which we can view how smart money, the large institutional players, operates in the markets. It suggests that market movements aren't random, but rather a calculated dance designed to trap retail traders and extract liquidity. Let's break it down. This is the quiet phase. Smart money begins to build its positions, either buying, accumulating long, or selling, accumulating short, without causing significant price movements. The market often appears to be ranging or consolidating. During this time, retail traders might see this as an opportunity to place their stop losses just outside these perceived support and resistance levels. This creates a pool of liquidity. This is the deceptive phase. Once enough liquidity has accumulated, smart money orchestrates a sudden, sharp move that appears to break out of the consolidation range, but in the opposite direction of their true intent. This is often called a stop hunt or a false breakout. The purpose? To trigger all those retail stop losses, forcing traders out of their positions at a loss and providing the institutions with the necessary orders to fill their massive positions. If they want to go long, they'll push the price down first to buy from panicked sellers. If they want to go short, they'll push it up to sell to eager buyers. This is where the rand manipulation tactics like pulsing and front-running fit perfectly. They are tools of manipulation.
At the heart of this scandal were private chat rooms, often on platforms like Bloomberg, where traders from competing banks exchanged sensitive information and coordinated their actions. These weren't casual conversations. They were strategic discussions aimed at influencing the market. The methods were varied and insidious. Traders were accused of fixing bids, offers, and bid-offer spreads, effectively controlling the price at which the rand was bought and sold. They also engaged in tactics like pulsing the market, which involved flooding the market with orders to create artificial momentum, and front-running customer orders, where they traded ahead of their clients to profit from anticipated price movements. Some even engaged in wash trades, trading with each other to create fake volume and manipulate prices.
Identifying accumulation, manipulation, and distribution has never been simpler using this one trick. But first, what is AMD? Simply put, it's the process where price accumulates liquidity in the market by holding price inside of a consolidation. Price is then manipulated to raid a liquidity pool on one side of the consolidation, and finally reverses to distribute that liquidity to the opposing liquidity pool engineered during the accumulation phase. Now the trick is, we incorporate time into our AMD cycle by looking at the Asian session, London session, and the New York session. And here's how we do that. When you get to the charts, highlight what the Asian session has done. Why? Because chances are, if it's accumulated, we can expect London to manipulate and therefore New York to distribute. Now, there's a caveat here. Say when you get to the charts and you see the Asian session has expanded instead of accumulating, then you should not expect the London session to manipulate. Instead, you should expect it to accumulate and therefore New York to manipulate. Put simply, it all comes down to what the Asian session has done. But let's move on to a chart example to properly illustrate the AMD cycle. Here, we've got this buy-side liquidity pool, and prices accumulated during the Asian session. So what do we expect the London session to do? Well, we expect it to manipulate by raiding buy-side. Now, the stage is set for the New York session to open, reverse, and distribute during the expansion to complete the AMD cycle.
Now, let's look at a legendary example of market manipulation that cemented George Soros's reputation as the man who broke the Bank of England. In 1992, Britain was part of the European Exchange Rate Mechanism, or ERM, which pegged the British pound to other European currencies, primarily the German Deutsche Mark. The Bank of England was committed to keeping the pound within a specific trading band.
George Soros, a man shrouded in political controversy and yet one of the most successful investors of all time. While many today are familiar with his political endeavors, there is a much more interesting story that has, in comparison, avoided the public spotlight. In this video, we're going back to the decade before the euro, where the Wild West of European currencies allowed George Soros to almost break the Bank of England, and to make up in 1992, the British economy suffered. Of course, just keeping interest rates high wasn't enough to maintain the pound's value. And so throughout these 2 years, the Bank of England would frequently go to the market and start buying up pounds by the millions, using up its foreign exchange reserves in the process. Even that didn't really help though, since the pound continuously weakened during this time, just barely within the limits of the ERM. Pretty much every currency speculator understood that eventually the British pound would have to devalue. But the billion-dollar question was, when would that happen? And the man with the answer was George Soros. He had been running his hedge fund since the 1970s, and his specialty was predicting and sometimes forcing the catalysts to big market events. He knew that almost everyone was ready to bet against the British pound if only there was some sort of bad news that could trigger a stampede big enough to overwhelm the Bank of England. Starting in August 1992, Soros and his fund began building a position against the pound, and here's how he did it. He'd go to a big bank or another hedge fund and he'd borrow pounds from them, with the promise of repaying them with some interest on top. Then he'd go to the foreign exchange market and he'd sell those pounds to buy German marks instead. The idea being that when the exchange rate drops, he'd be able to buy back those pounds cheaper, earning the difference as a profit. By the end of August, Soros had slowly built up a position equivalent to $1.5 billion against the pound. But the exchange rate had barely moved. He needed some sort of news to really start increasing his position, and luckily for him, on September 16th, the president of the Bundesbank held a seemingly innocent interview that Soros could nevertheless use. The Bundesbank president said that he doesn't rule out that some currencies might come under pressure, which in and of itself is a very vague and unconvincing statement, but Soros decided that it was good enough for him. That same night, while Europe was asleep, Soros called up any international bank or company, or really anyone that had British pounds, and he tried to borrow them with great success. By the time the British woke up, Soros had sold the equivalent of $10 billion worth of pounds on the open market. Unsurprisingly, the Bank of England was in complete chaos.
The same modus operandi was used by the Rothschilds in the 1800s. Here is the breakdown.
Money, Nathan made no less than 4 profits on the sale of the Wellington's paper, which he bought at 50 cents on the dollar, on the sale of gold to Wellington, on its repurchase, and then on forwarding it to Portugal. In 1815, the 5 Rothschild brothers worked to supply gold to both Wellington's army through Nathan in England and Napoleon's army through Jacob in France, and begin their policy of funding both sides in wars. The Rothschilds love wars because they are massive generators of risk-free debt. And this is because, as I said earlier, that they are guaranteed by the government of a country, and therefore the efforts of the populations of that country. And it doesn't matter if that country loses the war, because the loans are given on the guarantee that the victor will honor the debts of the vanquished, which means that those who are left behind has to carry the burden for the Rothschilds. While the Rothschilds are funding both sides in this war, They use the banks they have spread out across Europe to give them the opportunity to set up an unrivaled postal service network of secret routes and fast couriers. The post these couriers carried was to be opened up by these couriers and their details given to the Rothschilds, so they always were one step ahead of current events. Talk about a very clever intelligence structure. Besides that, these Rothschild couriers were the only merchants allowed to pass through the English and French blockades. It was these couriers who also kept Nathan Meyer Rothschild up to date with how the war was going, so he could use that intelligence to buy and sell from his position on the stock exchange in accordance with that intelligence. And yet today they want to control how people trade in stocks, and they want everything to be transparent. One of the Rothschild's couriers was a man named Rothworth. When the outcome of the Battle of Waterloo was won by the British, Rothworth took off for the Channel and was able to deliver this news to Nathan Myers Rothschild a full 24 hours before Wellington's own courier. That time British pounds were called consols, and they were traded on the floor of the stock exchange. Nathan Meyer Rothschild instructed all his workers on the floor to start selling consols. They made all the other traders believe that the British had lost the war, so they started selling frantically. Therefore, the consols plummeted in value, which was when Nathan Meyer Rothschild discreetly instructed his workers to purchase all the consols they could lay their hands on. When the news came through that the British had actually won the war, the consols went up to a level even higher than before the war ended, leaving Nathan Meyer Rothschild with a return of approximately 20-1 on his investment. This one event gave the Rothschild family complete control of the British economy, now the financial center of the world following Napoleon's defeat, and forced England to set up a new Bank of England, which Nathan Meyer Rothschild controlled. Interestingly, 100 years later, the New York Times would run a story stating that Nathan Meyer Rothschild's grandson had attempted to secure a court order to suppress publication of a book.
And for those of you looking to deepen your understanding and gain real edge, I highly recommend checking out JournalDock. Their community strategies section is a fantastic resource, offering depth of insight and practical applications of powerful trading concepts like ICT, AMD framework we discussed today. These strategies can help you identify institutional footprints, anticipate market moves, and ultimately stay on the good side of the market. Don't just react to the market, understand its hidden mechanics with JournalDock. Check out the link in the description.